So, you're thinking about jumping into the Nairobi Securities Exchange. That's awesome. It's an exciting step toward building your wealth. But, for newcomers, that path can be, well, it can be a little tricky, filled with some pretty costly mistakes. So let's dive into this and make sure you start your journey on the right foot. I'm sure you've heard this before, right? From a friend, a family member, maybe in a WhatsApp group. It's that feeling of hype, that fear of missing out on a stock that everyone says is about to just take off. It is so common, and honestly, it's the perfect starting point for our first big pitfall. If that feeling hits close to home, then you are in exactly the right place. In this explainer, we're going to break down the most common traps that new investors fall into, and we'll use these slides to make it all crystal clear. Okay, first up, let's talk about the psychological game, because honestly, the biggest mistakes often happen right up here, in your head, before you even think about clicking buy. It all comes down to your mindset. And this slide right here gets to the absolute heart of a huge point of confusion, the difference between investing and trading. You see, investing is a marathon. It's for long-term wealth, and it's built on patience and solid research. Trading, on the other hand, is a sprint. It's all about quick profits, often driven by hype. For a beginner, mistaking one for the other is pretty much the fastest way to lose your money. And that leads us straight into the hype trap. This is what happens when you buy a stock just because it's the talk of the town. We see this all the time during an IPO, an initial public offering. But here's a little reality check from the NSE. A lot of IPOs don't just soar. Some actually drop or just go flat right after they list. Buying on hype isn't investing. It's just gambling. Now, the flip side of buying on hype is, of course, selling on fear. When the market takes an inevitable dip, that gut reaction is to sell everything to stop the bleeding, right? But think about what that actually does. All it does is turn a temporary, on-paper loss into a permanent, very real loss. Buying high on hype and selling low on panic, that's the classic recipe for disaster. All right, let's switch gears and tackle the things you just need to know. These are the kinds of technical blind spots that can really trip you up if you're not ready for them. First, the absolute basic of basics, your CDSC account. The easiest way to think about it is like a bank account. But instead of holding your shillings, it holds your shares electronically. Every single investor has to have one. It's your official wallet on the NSE. Simple as that. Now, here's a concept that surprises a lot of people on the NSE: liquidity. See, just because you own a share doesn't automatically mean you can sell it in a snap. For a lot of the smaller stocks, there just might not be enough buyers on a given day. And that means you could literally get stuck holding onto shares you really want to sell. That's a pretty big risk. So we mentioned the word fundamentals a little earlier, but what does that actually mean? Well, it's about looking at the company like you're a business owner. Is it actually making money? Does it have a mountain of debt? Does it have a history of sharing profits through dividends? And maybe the most important question, is the price you're paying for a piece of this business actually fair? This is what real investing is all about. Okay, let's move into our third section, the practical, on-the-ground planning mistakes. These are the kinds of errors in strategy that can totally undermine even your best intentions. Oh, this one. I think we all know someone who said this, or something just like it. I'll just put all my money in one big, safe stock. And while it sounds so simple, it is one of the single riskiest things you can possibly do. And this slide right here perfectly illustrates the solution. It's called diversification. It's the old don't put all your eggs in one basket idea. Instead of betting everything on one horse, you spread your investment across different sectors of the economy. So if the banking sector has a tough year, maybe manufacturing or telco will do well. That balance is absolutely key to protecting your money. All right, let's talk about another classic oversight. Picture this. You sell a stock and you see this beautiful number pop up in your account. A nice, tidy 10,000 shilling profit. You're already thinking about what you're going to do with it. But hold on, not so fast. Before that money is truly yours, a few other people get their piece of the pie. Your broker takes a commission, the CDSC takes its fee, and of course, the tax man takes a 5% cut of your gain. For a lot of new investors, these costs can be a real shock if you haven't planned for them. And just like that, your 10,000 shillings is suddenly a bit less. Now, this is just a simple illustration, but it really drives home the point. You have to factor in the costs to understand what your real return on investment is. So, navigating all those costs and rules brings us to a crucial partner in your journey, your stockbroker. Choosing the right one is so important. don't just go with the most famous name. You got to ask, is their platform easy to use? Is their customer service actually helpful? And do you understand their fees? Also, know the settlement period. The NSE operates on what's called T+2, meaning your trade officially completes 2 business days after you make it. A good broker makes all this clear. A bad one, well, it becomes a real headache.
Okay, let's pause for a second because this might just be the most important question of all. Before you invest a single shilling, you need a goal. Why are you doing this? Are you looking for a steady income from dividends? Or are you aiming for the value of your shares to grow, over many years? Your answer to that question changes everything about which stocks you should be looking at.
So after avoiding all these pitfalls, how do you actually start the right way? Well, it begins before you even look at a single stock ticker. Before you dive headfirst into picking individual stocks, which is kind of like climbing a mountain, right? High risk, but high potential reward, maybe consider a less risky path to start. For so many beginners, starting with something like a unit trust or a money market fund is a much, much better first step. Think of it like a calm boat ride. It's professionally managed, and it's a fantastic way to get comfortable with investing before you try to tackle the mountains.
Because at the end of the day, success in the stock market isn't about finding that one hot stock. It's about avoiding these common mistakes, doing your homework, and having a clear, patient strategy. So I'll leave you with this one thought. The best investment you can ever make isn't a stock. It's a solid plan. So what's yours?